Bismillahirrahmanirrahim. Hello everyone. Today we'll just discuss about the investment appraisal, evaluating the profitability or desirability of an investment project. So in this chapter we will discuss that which project will give you more beneficial in sense of profitability and in sense of that how much you can get back your real investment. Investment appraisal is usually undertaken by using quantitative techniques that assess the financial feasibility of a project. Managers use investment appraisal techniques to assess whether the likely future returns on project will be greater than the cost and by how much. Non-financial issues can also be important too, and therefore qualitative appraisal of project might also be very important. So by using investment appraisal, managers find out how much they can get return on their investment on their specific project or investment, and there are different techniques generally used, quantitative and qualitative techniques used for assessing the project feasibility. Information is necessary for quantitative investment appraisal. Quantitative method of appraisal will make comparison between the cash outflow or the cost of the project and the expected future cash inflows. The initial capital cost of investment, including in the case of equipment or machinery, installation cost. The estimated life expectancy over how many years return can be expected from the investment. The residual value, the resale value of the investment at the end of useful life, the assets will be sold, earning additional net return. The forecasted net return or net cash flow from the project, these are the expected return from the investment less the annual running cost. So total amount of money you have to get from running a particular investment minus initial cost of that particular investment, then you find out either you can beneficial or not. So there are different techniques. There are 5 techniques generally used by a company: payback period, average rate of return or IRR, ARR, discounting payback, NPV, net present value, and internal rate of return. Now we discuss one by one. Payback method: the length of time it takes for the net cash inflow to pay back the original capital cost of the investment. So this technique generally inform you that how much years, months required that your initial investment return back to you. So basically, a year annual net cash flow and accumulated cash flow. Year zero, right now you invest 500,000 and you want 500,000 back. First year, your positive cash flow is 300,000 and your rest of amount is 200,000. Second year, you can get 150,000. So it's mean that your remaining amount will be 50,000. Third year, you get 150,000 and your profit is 100,000. In 4 year, your investment inflow is 100,000 and total amount of cash flow is 200,000. In last year, 100,000 include the residual value, resale value. So how you will find out in which years you can get your money back? Additional cash flow needed divided by annual cash flow in third year next year into 12. So in first year you can get 300,000, your 200,000 remaining. Second year you get 150,000, so total you get 450,000, your 50,000 remaining. The 50,000 of second year remaining will come back in third year. So your required payment is 50,000 divided by 150,000, that is third year investment into 100 equal to 4 months. So your payback is 2 years and 4 months. Why is the payback of a project important? Managers can compare the payback period of particular project with other alternative projects so as to put them in a off rank order to payback period can be compared with cut off time period that the business may have laid down. So basically, you have to need a comparison between different other projects. Payout, a business may have borrowed the finance from investment, and long payback period will increase interest payment. If a business get a loan for investment purposes, and if the and definitely on the investment on the loan you have to pay back the interest. So it's mean that if your payback is long too much high, but long, so it's mean that you have to pay a huge amount of interest on the loan amount. Even if the finance can obtain internally, the capital has opportunity cost of other purposes for which it could be used. The spreader of the payback, the quicker the capital made available for other project. Second main important thing is that if every capital has an investment opportunity cost, you have other options to invest it. So how quickly you can get back the money from your initial project, you have opportunity to invest in other projects as well. The longer into future before a project pay back the capital invested in it, the more uncertain the whole investment become. The a change in external environment that could occur to make the project unprofitable are likely to be much greater than over 10 years or more than. So basically, if you are investing the money in the particular project that can give you return more than 10 years up for long, then there may be chances that the cash inflow will be less because there is change in economic circumstances of the country, competition, government policies, and different other barriers can create a problem for you. So you try your best. Managers try their best that they have to put their investment in the particular project where they can get back their initial investment. Some managers are risk averse. They want to reduce the risk to a minimum. So quick payback reduce uncertainty for these managers. Cash flow received in future has less real value than cash today. Owing to inflation, the more quickly money is returned to an investing company, the higher will be its real value. So today you invest 10 rupees. It does not mean the value of 10 rupees is same in tomorrow because of inflation factors. So every manager try their best that they have to get back their initial investment in real shape, real value, but practically it is impossible. So you try your best that you have to put your investment in a particular project where the return is good and you don't feel bad that you have a less return on your investment or the value of your investment is less. Advantages and disadvantages of payback. Advantage is that it is very quick and easy to calculate. The results are easily understood by a manager. The disadvantage of payback is it does not measure the overall profitability of a project. Indeed, it ignores all the cash flows after the payback period. It may be possible for an investment to give a real repeat return on capital, but then it offers no cash flow. So the biggest disadvantage of payback period is that it ignores all cash flows. We have just focused on all those years cash inflows that can give return of your investment or your basic investment will be covered up. Maybe in future, in coming years, your return is so much high, but you ignore it. And this payback period ignore the profitability percentage, how much you get the return on the investment. Advantage is that the comparison this emphasize on speed of return of cash give the benefit of concentrating on the more accurate short-term forecasted of the project profitability. The result can be used to eliminate or seen out projects that give returns too far into the future. It is particularly useful for the businesses where liquidity is of greater significance than overall profitability. So basically, the period can give you easily assess a business that you have to find out a real time projects where your investment is safe and get back quickly. The disadvantage is that this concentration on the short term may lead businesses to reject very profitable investment just because they take some time to repay the capital. It does not consider the timing of cash flow during the payback. This will become clearly when the principle of discounting is explained in the final into two appraisal methods. The disadvantage of payback period is that managers generally ignore those projects where they can get a high return in future. In, but they just concentration their concentration is only their investment return. They want that they can quickly get back their amount of their investment. They never take seriously about those projects their return is coming later in the business. The second type of investment appraisal technique is average rate of return, that is also called ARR. It measures the annual profitability of investment as a percentage of initial investment. The formula is that annual profit or net cash flow divided by initial cash flow into 100. So in year one, year zero, starting year you invest $5 million. First year you return, you get back inflow is 2 million. Second year again 2 million. Third year 2 million, and fourth year third million 3 million. You sell your project. The fourth stage in calculating ARR, add all positive cash flow. 2 plus 2 plus 3. Year 1 to year 4. The total cash inflow is 9 million. So the next step is that from positive cash flow 9 million minus cash outflow 5 million equal to 4 million. So you can get 4 million profit. The next step is that 4 million you can get in 4 years. It's mean that 1 million per year profit you can earn on the particular investment. So how much your ARR? So 1 million is your profit divided by your investment into 100. That is 20% of your profitability on your investment. So 20% is your annual rate of return that you can earn in 5 years on a particular investment. Advantages and disadvantages. It is useful by the cash flow, unlikely the payback period. It's focused on profitability, which is the central objective of business. The result is easily understood and easy to compare with other projects that may be comparing to for limited investment funds available. The result can be quickly assessed against the predetermined creation rate of businesses. So basically the advantage is that you have to just focus on your profitability but you ignore your cash flow of payback. It's mean that this ARR does not include payback. You not calculating the payback period in ARR technique. Because why you have to focus on profitability? Because this is the main aim of the company, and the results are very easily understood by anyone. You have to need to compare with other projects, and definitely you prefer to those projects which ARR is higher. The main disadvantage is that it ignores the timing of the cash flow. This would result into two projects having similar ARR, but one could pay back much more quickly than other. As all cash inflow are included, the later cash flow which are less likely be accurate the incorporated into the calculation. The time value of money is ignored as the cash flow have not been discounted. This concept is considered after the next set of activities we will discuss later on. So the main drawback of ARR is that it can ignore the discounting rate. Discounting rate means that you have the inflation factor. But the value of today is tomorrow. So basically ARR generally ignore payback period. It ignore those positive cash flows. Their value is very less and they have to give back later on. So we ignore that. Third type of investment appraisal is called discounted payback. This method of investment appraisal uses discounted cash flows to calculate the payback period of the capital cost. This method considers both in size of cash flow and the effect timing of them. It does this by discounting cash flow if the effect of inflation are ignored. Discounting is the process of reducing the value of future cash flow to give them their value in today's term. How much less in future cash worth compared to today's money? The present value of future sum of money depend on two factors. The higher the interest rate, the less value of future cash flow has is today's money. The longer into future cash is received, the lesser value of today. So basically in discounting payback method, we have to use a different discount methods, discount technique, a percentage that we have to, at what percentage your money is tomorrow's money coming today. So you have to, basically in this method you have to calculate tomorrow's cash flows at today's rate. So year one your investment is 5 million, discount factor is 1%, like example 10%, discounted cash flow you want in 5 and your cumulative cash flow is 5. So year one you get positive cash flow 2 million, discount factor is 0.91 and the value of 2 million is 1.82 million. You have to multiply 2 million into 0.91. The answer is 1.82 million. So your required investment, remaining investment is 3.18, because out of 5 million you subtract 1.82, your remaining is 3.18. Second year your positive cash flow is 2 million. You multiply that cash flow with discount factor, that is 1.66. The value of 2 million that will come to your business after 2 years, the value of that 2 million is today is 1.66 and your remaining amount out of 5 million is 1.52. Year 3 again 2 million and discount factor is 0.75 and the value of 2 million of third year is the value is 1.5 in today. So your remaining amount is 0.02. In fourth year your cash flow will 3 million. Your fourth year 3 million positive cash flow, the value of that cash flow is 2.02. So 3 million into 0.68, that is discount factor, you multiply both of them, you get 2.04 and your positive cash flow or profit is 2.02 is your profit. So what is basically the payback period, discounted payback period 0.02 multiplied by 12 divided by 0.04 into is equal to 3 years and 0.11 month. So your investment coming back to you in 3 years and almost few days. NPV, net present value, next technique of investment appraisal. Today, today's value of estimated cash flow resulting from an investment. This method again use discounted cash flow is calculated by subtracting the capital cost of the investment from the total discounted cash flow. Three stages in calculating NPV. Number one, multiply discount factor by net cash flow. Cash flow in 10 years are never discounted. In 0 year, never discounted as they are today's value already. Number one. Number two, add the discounted cash flow. Third, subtract the capital cost to given NPV. So here in 0 year, your cash outflow is 100,000 at discount rate is 8% and we have to assume it is 1 and discounted cash flow is 10,000 you want to get back. So in year 1 your cash flow is 5,000 sorry, and discount factor is 0.93. You multiply both of them and you get 4,065. So year 2 4,000 and the discounted cash flow is 3,440. Year 3 3,000 cash inflow and your discounted cash flow is 2270. Year 4, your cash inflow is 200, discount factor is 0.74, and your discounted cash flow is 1480. So NPV is calculated now. Total discount, add all total discount cash flow. Example 4650 plus 3440 plus 2370 plus 1480. You add all of them, the value is 11940. So your original investment, actual investment is 10,000. Now you get the answer that your NPV is 1940. It's means a positive NPV. You accept the project. If your total discount cash flow is equal to your original investment, so your NPV is zero, or your total discounted cash flow is in negative figure. Example, if it is below than your original investment, the NPV is negative. So you will not accept negative figures projects NPV. You accept all those projects which have positive NPV value. What does this result mean? The project earn 1940 in today's money value. So if the finance need can be borrowed at the interest rate at 10%, the investment will be profitable. What would to happen to NPV if discount rate was raised? If interest rate increase, the business would be advises to discount future cash flow at higher discount rate. This will reduce the NPV as future cash flow are, are worth even less when they are discounted at higher rate. So the concept is here, if you are discounting using the 8% rate of your discounted cash flow, and if the interest rate of the bank is go higher, and then what should we do? So definitely you will discount your uh, project a cash flow at higher discount rate, and definitely that will decrease your NPV, and that is worth less than your actual investment. The choice of discounted rate is therefore crucial to the assessment of project. Using the method of appraisal, businesses will choose a rate of discount that reflect the interest cost of borrowing the capital to finance the investment. Even if the finance is raised internally, the rate of interest should still be used to discount future returns. This is because of the opportunity cost of internal finance. It could be used to gain interest if left on deposit in bank. The business would use this to discount the return on a project. If the NPV is positive, the project could be ahead. So the concept here, okay, the choice of discount rate is very important. If the discount rate is less than interest rate, prevailing bank interest rate, then what will be happen? And if the discounted payback rate is higher than the inflation rate, interest rate, what will be happen? Opportunity cost concept is also there. Advantages is consider both the timing of cash flow and the size of them in arriving at an appraisal. The rate of discount can be varied to allow the different economic circumstances. For instance, it could be increased if there was a general expectation that interest rate were about to rise. It considers the time value of money and take the opportunity cost of money in account. The main disadvantage is that it is reasonably complex to calculate and to explain, especially to non-numeric managers. The final result depends greatly on the rate of discount used, and the expectation about interest rate may be inaccurate. NPV, net present value, can be compared with other projects, but if only if the initial capital cost is same. This is because the method does not provide a percentage rate of return on the investment. So basically, it is very difficult to explain the result to those managers who not know about the finance. And second thing is that, okay, discount rate depend upon the interest rate, and interest rate can be vary due to of different circumstances and different allegations of government's legislation on it. And NPV value, you have to compare NPV value of one project with other. Internal rate of return, the net present value is widely used technique for investment appraisal industry, but does not give an actual percentage rate of return. And IRR, the discount rate of discount that yield a net present value of zero. The higher the IRR, the more profitable the investment project is. This rate of discount is then compared with IRR other projects. The highest reflect the most profitable investment. The expected cost of capital or rate of interest, and if IRR is greater, the project should be profitable. Taking the cost of borrowed capital into account. A cut-off rate or citation of return of a percentage by business, the minimum level maximum of payback period set by management for investment with a result for a project be accepted. So here there are three different discount factor rate: 8%, 12%, and 20%. Now you have to find out, okay, at which rate, at which point you can get have a zero NPV. Above upper that you can get accept the particular project. So zero at 0 year, initially you invest 30,000, and year one you can get cash flow of 15,000. Discount rate is at 8%. Discount rate is 13,950. At 12% rate is the rate is 13,350. At 20% rate, the discounted cash flow is 12,450. In year two till year four, you have different discounted cash flows at different rate. Now net present value of it at 8%, you can have a positive cash flow 7,150. At rate of 12%, you have NPV is positive 3,760. So 300 700. At 20% discount rate, discounted cash flow is negative, that is 1,600. So you have to find out, at you add all the positive cash flows of 8%, and then you have subtract from the initial investment, you have to get 7,150. Second, at 12% discount rate, 3,700. And at 20% discount rate, your net cash flow is negative 1,600. So at 20% discount rate, the net NPV is negative, but below around 18%, 18.5, a 6, or 18.17%, between above 12% and less than 20%, you have IRR. Advantages: by giving a percentage rate of return, different projects costing different amount can be compared. The IRR is easily compared with the rate of interest or the creation rate of business. It avoids the need to choose an actual rate of discount. The disadvantage is that the calculation is almost very difficult, and you have to need a scientific calculator or computer. By giving an exact result, it can be mislead business user into believing that investment appraisal is a precise process without risk and uncertainty. Qualitative factors: investment decisions are not just about profit. The impact of the environment and the local community. Growing concern about environmental issues is focusing businesses to consider carefully plan for development in sensitive areas. Bad publicity stream from the announcement of some proposed investment plan may disargue managers from going ahead with the project because of long run impact on image and sales. An example is the dispute over the building of a third runway at London Highway. This is an example for that. Closing related to this is risk that certain projects may not receive planning permission, and this could prevent contribution of the scheme. It is duty of a local planning officers to worth up the weight up the cost and benefit of a planned undertaking and to act the best interest of the community. Member of the community will often have a direct role through a public inquiry or maybe a pressure group to make their views known and try to achieve a particular outcome. So basically, cost benefit analysis company has to do that. If the cost is higher or of the particular project and the profit is less, the company can will not accept the particular project. And if profit is higher and the cost of particular activity is less, then definitely manager will accept the particular project. The aim and objective of the investment appraisal must be a key consideration. The decision to close bank branches and replace them with internet and telephone banking services involve considerable capital expenditure as well as potential for long-term saving. Different managers are prepared to accept different degree of risk. No amount of positive quantitative data will be conceive more managers, perhaps as a result of previous experience, to accept the project that involve a considerable chances of failure. So basically, these are the qualitative techniques we have to consider that other than profitability. An evaluation of investment appraisal due to uncertainty over future cash flow, operating cost, movement in interest rate, and other variables. The result of four investment appraisal techniques can be produced important guides upon which managers may build their final decision. A further point of evaluation concerns that conflicting future nature of a result that are often obtained from investment appraisal calculation. Should be a project with the fast payback period be preferred over one a higher ARR or NPV? Must be depend on the manager's attitude to risk and the balance of achieved between risk and potential future profit. Investment decisions should not be taken into a detailed consideration of objective of business. So share profit may be of less importance than a quick and relatively certain return of investment. So basically, the managers try their best that they have to invest in those particular projects where they can get quickly payback. They want this. They want to secure their investment. And some managers want to take a risk, and they have to invest the money into those projects where in the ratio of the time period of their payback is prolonged, but there is a good return on it. The significance of objective is again apparent when the impact of qualitative factors is being considered. Increasing weight is being given to these firms to these by firms in many countries as a result of growing impact of pressure groups and raising demand of ethically decision making to consider whether wider issues that are just short-term shareholder return. So basically, all those companies that adopt CSR activities and they find out their decision can have a positive or negative impact, and maybe pressure group and some ethical issues become a hurdle in achieving their objectives. So they also consider whenever they have to go for investment other than quantitative techniques we discuss in four. Therefore, investment appraisal results are often necessary but not sufficient guidelines for business investment decisions. For example, a clothing manufacturer could decide not to open a new factory in a country with no labor protection law for fear of pressure group action, even though the investment appraisal result have a positive. So this is, now you have to understand the concept very well, that how ethically and economically factors affect on decision making. So as here the example is there, if a cloth manufacturer definitely open a factory in those areas, those countries where there are huge potential of their investment, technique should tell you that if you invest the money in these areas, there is a good return, quickly payback, good IRR, good NPV, and good ARR. But due to some ethically and due to some pressure groups, it is not suitable. Therefore, investment results are often necessary but not sufficient guideline for business investment decisions. For example, a clothing manufacturer could decide not to open new factory in country with no labor protection law for, for fear of pressure group actions, though the investment results could be very positive. Again, same thing. The significance of objective is again apparent when the impact of qualitative factors is being considered. Increasing weight is being given to these firms in many countries as a result of growing impact of pressure group and rising demand of ethically decision making that consider wider issues than just short-term shareholder return. Therefore, investment appraisal results are often necessary but not sufficient guideline for business investment decisions. Thank you very much. Today we discuss these investment appraisal techniques. Hope you enjoy that. Stay tuned with me. Stay with me. See you next class.